So good morning again, everybody. Thank you very much for joining us. So just to start off, given the occurrence of 3 Black Swan events over the past 3 years in the Philippines, combined with uncertainties over the removal of long-held tax incentives for BPOs under PEZ, there's remarkable optimism in the overall market. There's a backlog of demand in the BPO office sector starting in 2018, when the possibility of PEZ incentives being eliminated was first raised by the government. In 2019, a moratorium was implemented, halting all new PEZ applications for projects in Metro Manila. In January 2020, the first Black Swan event happened when Taal volcano erupted. That's just located south of Manila, and it spread ashes even north of Manila, so that far, and it really interrupted the flow of business for the next about a month to 2 months. When in March 2020, we all know that COVID first hit, which was the Black Swan event number 2. Towards the end of 2021 or last year, there was a lot of hope creeping back. And then Typhoon Odette, which international name was Typhoon Rai, which was the level of a Cat 5 hurricane. It came through and devastated huge parts of the Visayas and Philippines. And then in January 2022, Omicron caught fire around the world. It was a little bit before that, but the Philippines was kind of a little bit later on most of these variations. Even though the Philippines made it through relatively well, it did put things on hold for a while there for another couple of months. Now with this latest variation of the pandemic burning out and the government pushing companies to force their employees back to the office, we're trying to find the right balance between the needs of the government and the private sector. While the office, retail, and hospitality sectors all took major hits, the industrial sector and parts of the residential sector picked up speed, fueled by the growth in e-commerce logistics and also the desire for housing and accommodations outside of the city. So these would be both residential subdivisions south of Manila and also beach properties or oceanside type properties. Land values in the industrial sector grew by an 8% average growth rate between 2010 and 2020. But that growth increased to 13% per year over the past 2 years. And I'll show some cap rates across the sectors a little bit later on. Meanwhile, commercial land values barely took a hit, even though NPVs and IRRs aren't as attractive as before. So it's kind of a stalemate right now in the market in terms of doing the juicy land deals. We just included this slide this morning, actually, and we can go back on it if you have any questions on our infrastructure. But a lot of the optimism right now in the market stems from the various infrastructure projects around the country. And what's not included on here that is worth pointing out would be the new highways and roads and bridges and overpasses around Metro Manila. So it's really, it's improved and decongested the main artery going south, which is to the industrial parks, where the majority of industrial parks are, and the subdivisions outside of Metro Manila. So, I mean, it's really cut travel time down. I mean, the full capacity yet of vehicular traffic, it hasn't really come back yet, like pre-pandemic. But so far, it looks very promising with the new highways in place, and it's reducing travel time by 1 hour going to some of these industrial parks. For me, the most important takeaway from this slide in this market aren't the actual figures for the interest rate and the exchange rate. It's the stability of both figures going back to even before 2015 in an emerging market like the Philippines. As long as businesses can plan under a stable economic and fiscal environment, they tend to be more bullish. Same goes for the security and political risk that has been mostly brought under control in the last few years. This is pre-Duterte. The most significant risk right now for companies with offices in Manila and Cebu could be the environmental risk, which we all hope won't become too regular. And then before moving on, there is a big election here in 2 months. We're all very excited about that, which pits Bongbong Marcos versus Leni Robredo, the son of one of the most infamous presidents of all time versus the current vice president. Historically, not many major investments are made during an election year, at least pre-election. So it actually comes at a good time as the country and the rest of the Asian economy's reopening efforts start to gain some momentum. Rosy outlook for the Philippines could be a very robust second half of the year following the election. All right, we'll just cover now some of the new laws that have been put in place in the last 1 to 2 years. So the CREATE law, first one on the CREATE law, number 1 there, which stands for the Corporate Recovery and Tax Incentives for Enterprises. It immediately reduced the income tax rate for corporations by 5%, with a 1% annual reductions until 2027 when it will reach 20%, in line with Vietnam, Thailand, and Cambodia. For micro, small, and medium enterprises, it lowered it by 10% to 20% effective immediately. After the income tax holiday of 4 to 6 years, there was a 3-year extension. This is pre-CREATE law. However, under the new CREATE law, there are no extensions. Here, let me just move to this slide here. So we really included this chart on here, not for you to read the whole thing, but so if you want a copy of the presentation, it's all summarized here. But basically, after the income tax holiday of 4 to 6 years, there was a 3-year extension. However, there's no longer an extension unless you relocate outside of Metro Manila. This is the drive by the government to really try and help with dispersion in terms of the traffic and the amount of economic activity in Manila. They're trying to disperse that around the country. Another major difference between PreCreate and ProCreate, or post-create, sorry, would be the 5% tax on the gross income earned indefinitely. So now it caps, after your income tax holiday of 4 to 7 years, it caps the 5% after 10 years. We do have a feeling, given the benefit that PEZ, which is PreCreate, that stands for Philippine Economic Zone Authority, who really governs all the incentives that are granted to BPOs and export-oriented businesses, manufacturing. It was a one-stop shop, and it was very simple. It was very easy. It was a very effective government agency, and still is operating. However, it's all been folded under the CREATE law. And so now PEZ has an additional reporting procedure and additional level of approvals needed. So it's kind of slowed down. So this is actually a really big issue that's ongoing that is going to be worked out kind of as we finish through the year. So the local banking sector is been highly resilient. So this is a Financial Institution Strategic Transfer Act, which is the new Special Purpose Vehicle Act to address the bank's non-performing loans and non-performing assets. The local banking sector has been highly resilient after safeguards were put into place following the 1997 Asian financial crash. An SPV law was enacted in 2002. One key safeguard in 2002 was the 25% cap on loans to the real estate sector after the 1997 crisis. Banks' NPL ratios in early 2000s hit 17%. Right now, it's at around 5%. So the big boys in this distressed opportunity and distressed investments around the region, they haven't come into the Philippines yet. And even the local big players haven't really taken advantage of this law, unlike before, which is a testament to the strength in the banking sector and the concern over really, no concern over the lack of liquidity. So there's ample liquidity in the market right now, which is also kind of underpinned the stability in the land values, and it's actually land values actually starting to increase. Like I said, even though the revenue variables haven't increased yet and have actually gone down. So the main incentive aside from the almost a tax-free exchange under this FISC Act would also be for the loss of the financial institution on the sale of eligible assets to be carried over for 5 years. Froy is going to, I'd like to introduce Froy, who's on the call. He heads our research department. He's going to cover the next couple of slides before handing it off to Vince Pillek, who is the manager of our office services team. We just wanted to give everybody an opportunity to share their thoughts here. So Froy, go ahead.
Well, thank you so much, Trent. And yeah, as Trent mentioned, I'm Froy, and I joined TFA mid-2020 as heading their research team. So the next 3 pieces of legislation that I'll be presenting are not entirely new, as they have been enacted for a while in the country. But these are amendments to keep the law updated to the dynamics of contemporary time. And these are previously anchored in either the 1987 Philippine Constitution that allows only foreigners to own up to 40% in many industries, or they have relatively high investment thresholds for foreign nationals. So they kind of amended these 3 major laws, and hopefully we will be attracting more foreign investments in the next couple of years. So the first one is the Public Services Act amendments, which has been there for around 8 decades already. And it essentially effectively liberalized key public services by allowing full ownership in some of the key sectors, which we consider critical infrastructure in the country, which are telecoms, airlines, expressways, tollways, and shipping. And as I've said, this is hoped to encourage more foreign investments in innovation, to lower the prices, to improve the quality of goods and services, and to create more and better jobs in the country. The second or the fourth law is the Foreign Investment Act amendments, which basically lowers the threshold of the paid-up capital from foreigners wanting to put up MSMEs in the country. It is now down to $100,000 US. This is way higher before it was amended. And it favors also startup and startup enabling business. And the last amended law is the Retail Trade Liberalization Act amendments, which reduces the minimum paid up capital for foreign retail enterprises. And it also simplifies its documentary requirements from foreign nationals, and it lowers the investment requirements for each store owned by a foreign enterprise. It also recognizes a reciprocity provision, which means only foreigners whose country of origin allows Filipinos to enter into their retail market are allowed to come into the country and basically put up a retail business in the Philippines. So those are the 3 laws in general, and we are awaiting for the implementing rules and regulations on most of these laws that I mentioned. And it is also, I just also wanted to flag, these are not new laws, not land ownership and land lease provisions that are still in place in the Philippines. If you're a foreign individuals wanting to own a privately owned land, it's still restricted to the 1987 Philippine Constitution. So it should be at least owned by 60% Filipino. And if you want to own a land that is publicly, owned by the government, you cannot do that, and it's restricted to Filipino nationals only. But in terms of land lease, if you want to lease a land from privately owned land, there are no restrictions whatsoever, and the government can accommodate some limitations if you want to lease land that are owned by the government, and they can convert land from essentially from a publicly owned land to a privately owned land to be leased out to foreign nationals up to a certain number of years. So basically, these laws and regulations plus these anchor or basic basic 1987 Constitution provisions is our hope to attract more foreign investments in the future. And the administrations, the current administration and the succeeding administration has been very eager to attract more foreign investments in the country. And that said, I'm also, I just wanted to hand this over to Vince, who's handling our office market.
Thanks, Roy. Thanks, Trent. Before I start, I'd like to thank Jonathan for setting the call up, and I'd like to welcome Pancas to the CORFAC family. And magandang umaga sa lahat, and magandang gabi sa lahat rin with those are Western partners. So just a quick background. I joined TFA 6 years ago. I handle mostly the office services group, which we represent companies who are looking to acquire or lease space in this Metro CBD. So today I'm going to discuss the updates coming from the Metro CBDs. So for this slide, that shows the how the Metro CBDs is divided. So currently, for Metro Manila, we have 6. Makati being the highest in terms of square meters at 3.9, and next would be Ortigas and Taguig. On the next slide, please. So this is the market right now. I know for sure, just like everyone else, or if not everyone, most of us, vacancy is at an all-time high. In our case, we record an all-time high at the end of 2021 at 18.1%. This is after a very strong landlord's market of an average of between 5 to 4% for the past decades. I think the last highest vacancy that we experienced was last 2009. Right after that, it's just a continuous of a strong landlord's market. And in order for us to fully understand how it became, how it ended up at that vacancy rate of 18.1%, I think it's crucial to some sort paint up a scenario, build up that to paint up that idea of what transpired on the past couple of years, especially the years 2017, 18, and 19, which we think plays a huge role in changing the landscape of the office market. I'm sure Trent touched on a couple of these earlier, but please, Trent, Ten, and Froy, let me know if I skipped anything, or if I was not able to include anything. But going back 2016, 2017, at the start of Duterte administration, at the very onset, Duterte was not keen on proclaiming new PEZA accredited buildings. This is mainly because of, number one, the goal is to rationalize incentives of PEZA companies or other IPAs or investment promotion agencies to in line with the new PreCreate Law. And of course, number two is to decongest Metro Manila. During that time, if if I could remember 2017, I mean, companies are losing billions in traffic alone, billions of pesos in traffic alone. So there was already a limited supply for PEZA accredited space, and if you're a BPO company, you need to be in a PEZA accredited company for you to in order for you to avail those incentives. And at the same time, during the time, especially in the years 2017 and 18, Pogo companies, online gaming companies began to really take off and take over as the main drivers of demand. Pogo meaning Philippine Offshore Gaming Operators. Basically, these are online offshore gaming operators, online gambling. As we all know, gambling is illegal in China, and most of the gaming operators outsource their operations outside China. With I think majority during that time was in Cambodia, and they saw the Philippines as a destination, an ideal destination for their expansion plan, mainly because of course generally we in terms of doing business we are more accommodating with this type of industry, with this unique setup, and they've already tested the market actually. Some Pogo operators have been operating in the market as far as 10, correct me if I'm wrong, as far as 2007, availing an IPA in the northern part of Luzon, which called STEZA, Cagayan Economic Zone Authority. So during that time, they saw basically Philippines as a destination for further expansion. And Pogo industry is quite different from the usual BPOs, traditional office industries, in such a way that for this industry, time is of the essence, and they're really more keen towards taking up space and operate as quickly as possible. Given that, I mean, it's a matter we've interviewed a couple of companies before. It's a matter of minutes, and they're already losing millions, right? So, them taking over the market, as you can see in the 2018 net office take-up graph, it increases from 650,000 a year to at least an average of 1 million from 2018 to 2019. So looking at the scenario, right? The government leaning towards decongesting Metro Manila, not proclaiming PEZA or space for BPOs within the metro. Then suddenly, Pogo operators coming in and taking over space. Mind you, they don't really negotiate rents, unlike BPO companies that run through the entire process. Freud, can you go back to the map on the page up? So among the 6 CBDs, only two cities that doesn't allow Pogo. The first one would be Taguig and the portion of Ortigas, which is Pasig. But aside from that, Quezon City, Makati, Bay Area, and Alabang allowed those Pogo operators to relocate and expand in the area. Bay Area being the major beneficiary of this industry, given that it's just a couple minutes away from the NAIA terminal, and that district is where, it's gonna be the future entertainment cities. We have all the casinos located in that area, so it's quite ideal for those industries to relocate within those. So yeah, given that scenario, we have the government going back. We have the government decongesting Metro Manila, limited supply of PEZA because of the government's push to proclaim PEZA outside Metro Manila, and Pogo companies coming in. The rent really drove to the point that we were receiving crazy rents. 2017 is okay, but go back to the rent first. 2017 is okay, but 2018 and 2019. Just to give you an example, last 2019, Trent and I were we're working with a traditional non-POGO company, a service office actually. We started negotiating a space in Makati at somewhere between 1,000 peso per square meter, which is more or less around $20 per square meter. In just a matter of weeks, we're not talking about months, a matter of weeks, that rate ended up, the last offer with that space ended up at around $43, which is 2,300 pesos per square meter. And crazy terms are being thrown out. I had a client where the landlord asked them, a POGO client, asked them to pay a year in advance. And it's normal to see rates that are way above the weighted average of that CBD for POGOs. And BPO companies that cannot compete with those industries. They were constricted to what's available in Taguig and Ortigas and some other developers that, especially the big ones, that try to limit their exposures to the industry, right? So, Roy Trent, can you go to the rental cost slide? Next one. No, under rent. Next slide. Right. So to give an idea, to further emphasize on what happened last 2017, 18, and 19, you can see the graph, right? It was a steady growth in Bay Area. I mean, this is on the weighted average rent. So I mean, all those, even the non-POGO cities like BGC, Ortigas benefit simply because of BPO companies going not competing to POGO companies, right? So you can see at the peak of 2019, I mean, Bay Area, we saw a couple of transactions where the entire building is leased out before it's being completed, leased out by one company, right? Roy, go back to the first slide where the vacancy and take up is. So thank you. One more. So given that scenario, I mean, the crazy scenario, we're positioned towards a really strong landlords market. I mean, there was a point that vacancy for Bay Area was at 0% or 100% occupancy, and Makati is at 0.2%. Companies are scrambling for space. Then again, pandemic happened, right? And all of us are more on the wait and see attitude. It has been a negative take up for the past couple of years. It is expected. 2020 is around 183,000 square meters negative net take up, and last year we recorded a negative take up of around 273,000. So what's the scenario right now, right? What happened? Go to the demand driver slide, please. All right. So looking back at the demand driver comparison, you can see how it's divided, right? POGO companies, they've acquired majority or a chunk of a space. So from 1 million square meter transactions for 2019, we're down to 422,000 transactions last 2021. This is mainly composed of traditional offices and BPO companies looking to acquire space again or go back to the office. All right. Go back, yes, in this slide. So next slide, this one. Right. So before last 2017, 2018, BPO companies cannot find or not having a hard time looking for PEZ space in the market. But as of right now, I mean, there is an abundant supply of PEZ in the market. Well, in theory, when the CREATE law is implemented, they don't really need to be in the PEZ accredited building. But just like what Trent said, I mean, that trust and that confidence of BPO companies to avail or to go through PEZA for their one-stop shop and all those other services. We think looking at PEZA is still important, the supply. So for the last year, for 2021, we recorded an available supply of 1.3 million available PEZ space in the market, with an upcoming supply of around close to 740 square meters by the end of 2023. 59,000 of those are pre-lease. These are offices in Makati and Alabang, right? And the pie chart shows the division or the market share of the 6 CBDs for PEZ accredited buildings, right? Makati being, of course, the highest, since majority of the locators are POGO companies, right? Please go back again on the first slide, on the take-up slide. So if you're gonna ask me what's the opportunity right now, right? What's the meaning of 18.1% or close to 19% this first quarter? In our experience, especially in the past couple of years, I mean, after receiving crazy offers, after reviewing crazy rents, we now saw some sort of a pivot towards a more favorable terms towards the tenants. So last year it's normal for us to receive an offer 30% and 30% below the actual asking rate. So I mean a discount margin of 30% with an extended concessions of a delayed escalations and increased number of rent-free periods. I mean, landlords are competing right now for tenants, right? So the opportunity right now, of course, is for companies to avail this window of opportunity, this small window of opportunity for them to acquire the best possible value out of their offices. So there's an abundance of fitted space available in the market. Companies that are currently leasing in grade C buildings can now afford to lease on a higher tier or higher class buildings like grade B to grade A, right? Companies can easily consolidate right now, since there's a huge chunk of office supply that's available in the market for them to consolidate. And we've seen increase. We've seen companies, despite the pandemic, consolidate or acquire space in the market. And just recently, just by Q1 alone, we recorded a gross take up of around 184,000. This is we're projecting it to at least recover from somewhere between 300 to 400,000 square meters by the end of 2022. This is backed by, of course, a clarity on the new tax system. The new election, this coming election plays a huge factor as well in the decision-making process of the companies, right? But in terms of opportunity, it's leaning towards, just like what I've said, it's leaning towards a more tenant favorable market right now. So companies are taking advantage of it. I think that's it for me. And if you guys have any question, let me know. Trent, do you want to add up on those?
No, that was very, very comprehensive, Vince. And I think maybe we can just leave some of it for any questions we have a little bit later on. But I think just to summarize, just to add on to that a bit, I think just for informative purposes, I think what we're seeing right now is a lot of space in the market that is warm shell at the minimum, sometimes fully furnished, so almost plug and play. So we're seeing space like that is actually, there's a quite a demand for that right now. There's as Vince showed, there's an overhang of space right now from some companies downsizing, some companies leaving, closing. But mostly for the big multinationals here, they didn't miss a monthly rent payment and they held on to their space. Some of the smaller ones were the ones that left or vacated a floor here and there. And those are the ones where there's a strong demand right now from companies that are looking to consolidate their operations, or take on some additional space because they have an account that has been waiting to expand in the Philippines, waiting until things stabilized. And they're taking advantage of the softer market now because it's the first time in 10 years that the market's, not necessarily been a landlord's market. And so you're getting up to 6 months, sometimes a little bit longer rent-free periods, along with rents that are about 20% below what they were at the end of 2019. So on this slide with the cap rates, I know there's nothing sexy here with our cap rates, but it is what it is. So I think what has been just really the desire to invest in the real estate market isn't necessarily a yield-driven thing from new investors. It's really because of the appreciation potential in all of these sectors. So they're willing to take a slightly smaller return on their investment in exchange for the longer-term appreciation in the market. So on the next slide, I just have the REITs. So if you'll look at the cap rates from before and look at the yields on these REITs that they're giving out every month, you can see that the yields on the REITs are higher than the office yields on the previous slide. So I guess if you're an individual or a smaller company, it's just as easy to invest into a REIT than it is to build your own development or to try and buy something, because there's such yield compression right now in the market. So the REITs have unlocked this huge fresh source of financing for developers. The race for yield is intensified, and it's going to keep downward pressure on cap rates overall. The access, one thing to really point out is the access to this ample source of financing has really accelerated the separation between the large players, the large developers in the market, and the rest. So it's kind of like the tech divide where, the tech companies has accelerated their growth. The pandemic accelerated the growth of tech companies and distanced themselves from some of the other traditional companies and industries around the world. So far, these are all office REITs, except for the second one, which is a renewable energy REIT. And then the last point, which took so long, we've been talking about REITs in the Philippines for 10 years. It's gone back and forth between the House and the Senate. One of the main points, aside from the removal of the 12% VAT, because all these assets so far have been from a REIT, to use as an example, the first one, that's Ayala Land. So it's really just their assets that Ayala Land owns being transferred into a REIT. So they removed one thing that was held it up for so long. The passing of the REIT bill was the 12% VAT. So they removed that and the transfer of assets. And the second would have been the required public float. They settled on 33% of the shares need to be floated to the public by the third year. Previously, it was going to be 67% by the third year. And TFA, we've been here for since 2011. I also wanted to introduce my wife and partner who founded the company with me, Jenny Tan. And also our other partner as well is on the call. Her name's Christine Tolentino. Her name's, or Ten for short. She just took the bar about a month ago. So she'll be a lawyer soon here. So congratulations to Ten on that. And then also on the call is aside from Froy, for my team, we have Doug Chaffee. I'll get around to here. So Doug Chaffee will be starting with us very soon. Doug is going to be heading up our industrial focus. So we have ample industrial material to discuss. We didn't really include that here, nor did we include Cebu. Cebu's still being cleaned up, to be honest, after the typhoon came through. There's still parts of Cebu that don't have power. And also Palawan is also still being cleaned up. So we have information on the tourism market as well that we can share maybe on the next presentation. So we appreciate the opportunity to present to you guys today. We haven't done a broad overview of the market in quite a while. We usually tailor our presentations to a specific market or sub-market or problem or goal or solution, tenant or investor. So I hope it was informative and you all are still awake. And we welcome any and all feedback in the name of continuous improvement. Thank you.
Thank you, Trent. That was awesome. And I hope you don't mind, I've been recording this, so I do plan on sharing it with the group afterwards for those who want to listen and look at it again. I would just say, anybody have any questions, let it go.
Yeah, so I have just one question. Thank you so much for showing us the entire market overview. It's more or less like India, wherein during the COVID time the wave just took away the potential from commercial market, but it's coming back again. So I have one question: how's the co-working market doing in Philippines? Because in India, the major space consumers are the co-working companies now. They are taking it themselves, and they are also taking it as managed office for a lot of corporations, because a lot of companies do not want to straight away get into the long-term lease agreements with the landlords and lock in, etc. So they are going through co-working companies as managed office. So how's that market going in Philippines right now?
I'll answer first, Vince, and then maybe you can add in. So let me just get to this real quick. So the co-working market and the structured office or service office, it's evolving as we go along here. It's becoming more, I think, flexible actually, and also more. They're offering more services now rather than that traditional service office and a traditional co-working. They're actually doing build outs now, build to suits. There's a couple new players that have come into town as well in the last 2 years. Even so, as they want to have a presence when the market really opens up. There's a lot of seats that have been vacated, however, but they're starting to, I think, gradually be filled up because the co-working operators that are here have had to, they've been very competitive, right? So they've had to reduce their rates quite a bit. Maybe Vince, you can touch on what the cost per seat is right now. But as you can see in the 2019 demand driver comparison, we had 3% of the total take-up was from the flexible workspaces and co-working. And that was only growing. I think that was going to be, if we, the pandemic didn't happen, I think we would have easily been at about 5 to 6% of the total take-up in the market would have been co-working or service offices. So it's a rapidly growing sector right now. It's just, they are also having, the smaller ones have closed. And so they've had the seat rationalization is in effect right now. And it's also tied to the overhang in fitted space or fully furnished space. Companies that have a large presence in some of these co-working operators, they've leased out this fully fitted space instead, because they can get a 5-year deal, which is going to come out probably half the cost over 5 years versus if they stayed with that co-working provider. Vince?
Yeah, Trent, please go back to the map. Thanks for the question. So majority of the locators are located in the CBDs in Makati, Taguig, and Ortigas. Taguig having the chunk of the seats or the co-working seats available in the market. I mean, during pre-pandemic, Trent was correct. I mean, we're looking at the steady growth of the industry. I mean, we've seen companies when we started, that was, if I could remember, 2016. We were closing smaller accounts here and there, and the usual tenant profile for co-working space are smaller companies that wants an address in a metro CBD. But as the time goes by, I mean, some BPO companies look at that model and it works for them. So there was a huge increase in terms of demand pre-pandemic for co-working space, mainly for managed facilities, BPO companies. opting to go to co-working for their project-based accounts, six months to 1 year. But after that, I mean, it's more of a at the middle ground. I mean, there are companies that service office companies that closed their operations during the pandemic. Bigger players became creative on their services. Some even provide delivered computers, internet on employees working from home. So it's kind of a mix in terms of rate. There was a point where vacancy was really high, especially in the areas of Taguig and Makati, where service office operators are forced to really lower the rate at cost, just for them to pay the rent and pay their staff. Where it's more of a remedy strategy. But as of lately, we've seen increase in occupancy, especially in Makati and Taguig, and of course Ortigas as well. But the rates are still more flexible.
Sure.
Yeah.
In India, suddenly the consumption by co-working companies have increased dramatically because the tenants do not want to commit themselves directly to the landlords, do not want to commit lock-in, etc. So right now we are focusing on the co-working segment very aggressively. They are the best takers of a space right now.
I see. In terms of rate, did it increase, or it is more of a stable rate for co-working?
Oh, they have come down. I will say they are reduced by at least 25%.
I see.
Post-COVID and pre-COVID comparison, at least 25%. And there is also a change. Earlier, co-working companies were going little out of CBD areas also, but now they all have understood that their location has to be very well connected by public transport, metro, good parking, and they have to offer good cost. So they, in India, they have just turned around their model very fast, and they are the best space consumers right now. In fact, so much so, a company like Google is also going through the managed office agreements. So that's a big proof that how co-working is changing in India.
Sorry, one more question, Pancas. Had the layout, the overall service change for co-working? Is it more tailored towards the hybrid setup, or is it still tailored more on the BPO, the typical traditional office setup? Curious to know.
I will say no major change in terms of the space planning. No major change, except one, that the common areas like the lounges, the breakup areas, etc., are increased a little bit more than earlier. But more or less everything is same.
Pretty much the same.
Yeah.
Yeah. Cool. Yeah, I hope we answered your question.
Absolutely.
If we could set up another call, I'd love to talk about more on the service office with you and the rest of the team.
Sure.
The co-working space.
Absolutely. Definitely.
Anybody else have any other questions? Ray, do you?
No, very much. Thank you. Appreciate the comprehensive overview there. Oh, can you hear me?
Yep.
Okay. Yep. Yeah, much appreciate the comprehensive overview.
Thanks.
So I know.
All right. So I think what you'll be seeing over the next 2 months here is a lot of this here. 10, would you like to comment on this? She's a big supporter of Lenny.
So we've been under autocratic rule for 6 years, and we want to change that. It's also going to translate to a lot of, it's going to impact the economy for sure. Actually, I think many aspects of our economy suffered during the pandemic, not from the pandemic per se, but how it was handled by the current government. So I don't know if you've ever heard of people power, the bloodless revolution 3 decades ago in 1986, but it's happening again now, as it usually does when we're faced with an autocratic government. Hopefully, you know, the ideology swings towards the more to the center again, more liberal policies. And yeah, we were on a good track. We were on a good economic track with the previous president. I don't know what happened, but that's hopefully is going to change. It's become a people's movement. A lot of us are out on the street, you know, handing out materials, really making sure that whoever takes over is not beholden to any single entity or big business or political dynasties. And hopefully that's going to change everything, and better economy, better real estate opportunities.
We're just about in an hour right now. And this is a great conversation, so I don't want to cut it off, but does anybody else have anything they want to say? Any questions, any thoughts about opportunities in their markets, things their clients are looking for? Daniel, you're on mute. I don't know if you're.
Sorry, I didn't know. Thank you for that, Jonathan. One of the best phrases, right, of the last couple of years. I wonder if there was particular industries which are being promoted more so in the Philippines, and in particular for foreign companies coming to the Philippines. Are there particular extra incentives, and in particular for industries?
It's a good question, Daniel. And I think where the Philippines has lagged behind is really putting the big neon light up saying that we're open for business. It's been a little lackluster in terms of, you know, marketing the country, having a organized, you know, influential approach to attracting investors. And that's, I think, why Vietnam, Thailand, Malaysia, to a certain extent, why they've outperformed the Philippines, especially on the manufacturing side and the industrial side. So obviously, I think that the main I think attraction right now would be on the increase, you know, due to pandemic-driven type of and infrastructure-driven type of developments, and that would be kind of the e-commerce. So data centers are really coming in right now due to that, and then logistics as well. All the, you know, big logistics companies around the world are here and mostly looking to expand as well. So I think those two sectors. I would like to see some, and Doug maybe might want to share a thought or two on the semiconductor industry, because his family is heavy into that. But I wish we could really attract some of that back to the Philippines, because they were here for quite a long time. I know some of that push is due to the U.S. trying to onshore some of the, you know, the big factories there. And then renewable energy, I think, would be another sector, just due to, I mean, anytime you have, you know, the need for more power, the need for more healthy power, environmentally friendly power, we're seeing more renewable energy investors from Europe, from the U.S., from different parts of the world coming in now as well.
Okay. Thank you. Thank you. Excellent presentation. Really
Thank you.
Great coverage of the market. Very impressive. Thank you to you and your team, everyone. Thank you.
Thank you, Daniel.
Anybody else have any other thoughts, comments? Like I said, this is being recorded, so I'll share it with you all. And we'll send something out soon about the next scheduled meeting. We're going to try to have these at least every 2 months. I think it's a good chance for all of us to stay in front of each other, so to speak, but that shouldn't stop any of you from talking regularly. I hope this helps in that process. And Daniel and Ray, I don't know if you have anything else, but thank you all very much.
Thank you. Thank you, everyone, for your participation, and we look forward to further cooperation, all of us together. Thank you.
Absolutely. Thank you so very much.
Thank you.
Thanks, guys.
Thanks, everybody.
Thank you.
All the best, everyone.
Thank you.
Have a good day. Thank you all
Thank
very
you.
much.
Thank you.
Especially
Thank
those
you.